This show is produced by the Hartman Media Company. For more information and links to all our great podcasts, visit hartmanmedia.com.
Welcome to The Commercial Investing Show, where we analyze, explain, and exploit the opportunities presented in today's commercial property marketplace. If you're interested in apartments, mobile home parks, self-storage facilities, and other income property, you've come to the right place. We'll explore what's hot and what's not in markets nationwide in the relentless pursuit of return on investment. Here's your host, Jason Hartman.
Welcome to this episode of the Mortgage Minutes. We are joined today by one of our favorite lenders. How are you today?
Good, sir. How are you, Adam? Thank you for having me.
Absolutely. It's great to have you. I wanted to have you on because we haven't talked mortgages in a while, and there's been a whole lot of change since the last time we talked. But I want to start first with the whole notion of rates increasing. And one thing that I kind of laugh at is people talk about how rates are higher now. But realistically, I look at where rates are today, and we'll get into the exact numbers in a second. But they're really what I was paying. They're really on the low end of what I was paying for properties, back 1 to 2 years ago. Where are rates, historically speaking, as from your time in the mortgage industry?
Oh gosh, well, I've been in the business for nearly 20 years. But as it relates to turnkey financing and investment property financing, we started to concentrate on that about 7 or 8 years ago. So if you're looking at that timeline. Historically speaking, within that time frame, the current market rates are still quite good as it relates to, your typical investment property, single-family home with 20 or 25% down. Certainly at levels, they're certainly close to pre-COVID rate levels, I would say, maybe a little bit better, like you said. So historically, still very good, but from what we've been used to for the last 18 months, 12 to 18 months, certainly they've popped off what I call those COVID lows. The pandemic obviously is a global issue, a global phenomenon, has put market rates at a very low level historically, in fact, all-time lows. So we were spoiled a little bit in terms of being able to produce or sell interest rates at levels that were unheard of or unseen before. So it does become a little bit of a rate shock to folks when they see, especially the last 2 or 3 months with some of the changes that have occurred in the industry and with Fannie and Freddie, to see rates pop up back to more of a historical level. But again, still quite good.
Yeah.
But, to give you some answers or maybe my thoughts on the reasons why we've come off those lows. Well, a lot of the stimulus packages that were passed, and even the infrastructure bill that's being floated now, they're all, really Treasury bonds that are financing that or issuing Treasury bonds to do so. There isn't a tremendous amount of demand for Treasury bonds, with the stock market continuing to hit all-time highs across all levels of the market. The Dow, the S&P, the NASDAQ, all of them kind of reaching new highs at any other week here. So we're not seeing an awful lot of demand or, demand for bonds, which, mortgage-backed securities or Treasury bonds. So we've seen rates kind of pop a little bit off of just a natural reaction to the market. But also Fannie and Freddie have instituted or brought out some new guidance as it relates to investment properties and second homes. And they've basically mandated that every lender who produces these loans to them cap their production at 7%. So some of those smaller lenders, smaller volume lenders, will certainly put loan level price adjustments on or artificially add to their interest rates to slow down that production. Some will, put credit overlays or credit guidelines on top of Fannie and Freddie's guidelines, to slow down that production. An example of that might be they will only do 25% down, or an example of that might be they will not allow a borrower to do up to 10 finance properties like the big banks do, So things like that are happening as it relates to more recent times and what Fannie and Freddie have come out with as their new guidance. I think some of that is a knee-jerk reaction in relation to the volume that was produced in 2020 with rates as low as they were. You don't typically see your investment property portfolio refinance at the rate that it did. Like, for example, we were refinancing some of our turnkey investor clients that have 5, 6, 7, maybe 8 or 9 properties and refinancing them all at the same time. So that's unusual in a normal market for that to occur. I also think that you had, folks that had cabin fever and folks that would normally take a family vacation, for example, and go to Europe or go to Africa or go, somewhere with their families and spend some money there, had cabin fever and they couldn't travel, and they looked at the second home market as a way to kind of break out a little bit. So there was a lot of demand for second homes, and that was a spike over normal volume that you would normally see. So the guidance from Fannie was we're going to cap the production of second homes and investment properties to 7% of a lender's total production. And I think it's relatively temporary. I think it's a 52-week guidance to see how lenders react to it and see in a year from now whether that will be reversed or renewed. So I think what we're seeing is rates are higher as a result of some of that.
Yeah, so with that, if it is a 52-week guidance and it does go away in, I guess at this point it'd be something like 44 weeks or 40 weeks or whatever.
Yeah, maybe March or April of next year.
Yeah, what would you expect the impact to be if they did do away with it?
Well, I would say, in addition to that, though, at the end of the year, Fannie also put on an artificial price add-on to investment properties for refinances. They added a 0.5 point as a loan level price adjustment for any refinance. So I think if the production levels are curbed or slowed, that I think by next year you might see rates come back down a little bit further, particularly if we haven't emerged fully from the recession, right, the COVID-related recession. I mean, certainly the economy is doing better. Certainly the vaccines are going to help. The vaccination level is going to help in terms of getting industries back to normal. And these stimulus packages are going to create jobs. However, it may not be for some time before we realize that. So I think if these guidances are reversed or at least slow, they've curbed the production. With the current rate environment that we're in, we're going to revert back to a normal level of production for both second homes and investment properties. So I think what we'll see is some of these artificial price add-ons to rate will disappear.
Okay.
And then you'll be truly in maybe a little bit better of a rate environment. But again, that's always going to be subject to how the market's reacting and how we evolve out of recession too. So I think that there's some economic thought out there that the stock market will continue to rise. I don't think there's really an end in sight to that at the moment, but I guess you never know. As we come out of the COVID-related recession, I think they're probably right a little bit. I think it'll probably continue to go, but it should stabilize.
Yeah. So let's talk about rates then. I mean, a lot of times in the past we've talked about, rates for homes in the $100,000 price range, but as I'm sure you've seen as the volumes come in, those homes don't really exist much anymore. So we're going to talk today about more of the $200,000 house. What are we seeing rate-wise for a $200,000 property? Yeah,
and I think that as it relates to price, I think that's something to do with inventory as well. Obviously, there's a shortage of inventory, so you're seeing price increases because of that, and you're also seeing more new construction in the market. But yeah, a $200,000 purchase price with 20% down. Today we're going to be at like 4.75 with no points. But if you paid like a little over 2 points, like 2.1 in points, you'd get down to maybe 3.875. Sometimes you'll get to 3.625, depending on FICO and depending on loan size. But generally speaking, between 3.6 and 3.875, you're going to see, with 2 points and 20% down, you can get down to that rate level. Now, compare that to 25% down, and we're going to be at like 4 1/8 to 4 1/4 for 25% down. So when I look at that, I see better value for money for a client who's putting 20% down and paying 2 points, like 2 points being 2% of the loan amount. So on a $150,000 mortgage, you pay an extra $3,000 in fees or in points to buy the rate down to 3.875. That's better value for me than putting the extra 5% down. on a $200,000 price, because that's an extra 10 grand that only gets you down to 4.125 or 4.25. So by putting less money down, you actually can get a better interest rate. The points then are also tax deductible for our clients. So they haven't changed that tax code yet, so hopefully that stays in place. But the points are also tax deductible. So what that means is, let's say your income tax bracket is 30%. You can get 30%, let's say, of the points that you paid when you purchased the home back as an income tax break. Okay, so just reduces your income tax burden a little bit deeper. So I think that's good value for money, and overall you're going to buy a rate down to a level that probably won't be touched again, or it'll be very difficult to get rates back down to that level again without another pandemic or something major happening globally.
And without paying another loan origination and another appraisal and all that other fun stuff. We haven't talked about this in a while. What is when you're looking at, kind of what you recommend to your clients and borrowers, when you're looking at pain points and getting your mortgage payment down, what kind of break-even timeline do you generally look for whenever you're talking about buying points?
I'm looking for a break-even. Like if you spend that $3,000 in points to buy the rate down, when you compare that to the rate with no points,
right?
So you got to look at what the payment is at, let's say 4.75 versus 3.75, let's say, or 3.625, and see what the savings are on a monthly basis. It could be $100, it could be $110 a month or something. If you can break even on the cost of those points, I would say generally at the 3-year break-even mark, maybe a little bit higher, certainly no more than 4 years break-even. That's good value for me because it's a long-term hold. It's a 30-year fixed rate. You're buying the rate down to a level that we anticipate not maybe touching again, and not refinancing just through COVID for the sake of refinancing to a lower rate. Not necessarily taking cash out or anything else, but just to refinance the existing debt on your investment property. I think if you can break even on the cost of those points in 3 years, give or take, then you've got 27 years of those savings, right? So, let's say you save $100 a month on your payment. You'll save $100 a month. Yeah, you save up like $32,500 over the life of the loan in interest, and you'll spend $3,000 up front to do it. So that's pretty good ROI on that $3,000 over the life of the loan. Now, of course, are you going to hold on to it for 30 years? Who knows? But at least if you hold on to it for 15 or 20, you're still going to come out way ahead.
Yeah.
So I look at the break-even, Adam, of 3 to 4 years as on an investment property. If this was your primary residency where you were refinancing, on the overall cost, not just points, but on the overall cost, you want to be breaking even in about 12 months.
Great. One of the things that I've been curious about is in this environment where we're seeing so much appreciation all over the country, and especially in the markets that our clients are buying properties in,
yes.
Are you seeing people going even lower and and I don't even know if y'all have programs at the moment that do this, and doing like a 15% down, pay the PMI for a couple of, 6 months, and then do another appraisal and see if the appreciation has pulled you up to the 20% mark?
Well, the 15% down option has a couple of layers to it, right? First of all, you cannot have more than 6 financed homes. It's a Freddie Mac product that allows you to do 15% down. So if you've got less than 6 financed homes, it is an option. On these price points, that PMI with a good credit score really isn't a lot every month. So some folks will try and do that. You have to have PMI in place for a period of time before they will just drop it when you show them that your appraised value is higher. But technically, yes, you can do 15% down, take the PMI for the short term, ask the servicer then to do an appraisal on the property, let's say 6 or 9 or 12 months from the day you bought it. If the property has appreciated to the point where you're at 78% loan to value, you can then request the servicer to drop that monthly PMI. Maybe it's $30-$40 a month or something. And that's just it's not a refinance. There's no cost to it other than the cost of the appraisal. And then those servicers typically will say, well, you were supposed to have your PMI for X amount of years, but a lot of our clients will say, well, I have the value now. I can always simply refinance away from you and pay the refinance costs and get rid of my PMI. So when that happens, the servicer would generally say, okay, we don't want this to churn. We don't want this loan to be originated 9, 12 months ago and then disappear, right? Because there's no money in it for them. So they'll typically just play ball and drop the mortgage insurance monthly amount because you are technically at 78% or better loan to value. But that's really a conversation or a transaction that you do with the servicer of your loan once your loan's established and once you've asked them to do a new appraisal.
And so let's talk about kind of the mortgage starts and kind of the level of business that you're seeing. You talked about how when, the COVID lows were there, it was really, you're getting bombarded, just getting swamped with people wanting to refinance and buy with the rates where they are. Now that we're, a couple months into slightly higher rates, but, we're still seeing an inventory shortage everywhere. People are still buying homes like crazy. Have the mortgage starts in your office tailed off at all, or are y'all still at the same levels, or kind of give us a hint of what's going on in the market mortgage start wise?
Best way for me to kind of show that, it would be just our loan volume or closing volume, right, or our application volume. So let's say November, December, January, when rates were super low and we were taking a lot of refi applications and all of our purchase applications, we were probably taking in about 150 to 160 apps a month and closing anywhere between 100 and 120 loans per month. So our app-to-close ratio is very good. We're still closing at about 100 loans a month. Some of that is just legacy pipeline. But our application volume has not diminished all that much. We're still seeing application volume come in at a clip of about 100 to 110 loans per month. So for us, that's good. I mean, it's probably a testament to our team and our execution, also a testament to our rates and stuff. But also, I think there's a large enough company, volume-wise, where they're not impacted as much as, let's say, some of the smaller lenders and competitors that we go up against in terms of how those guys have adapted to curbing the production to stay below that 7% cap rule from Fannie and Freddie. So I think we're seeing some volume come through or some application volume come through from clients that we may have worked with in the past, but they may have tried out with another lender, and now that lender has got loan level price adjustments or guidelines that are not as favorable, let's say, as ours now. So we kind of win a little bit in the sense that our company's overall volume to Fannie and Freddie is quite big, but also just our independent individual team here, I think it's a testament to their execution and their knowledge of the industry, and also our ability to keep rates relatively low by showing the value of paying points to a degree.
All right, fantastic. Is there anything I haven't asked you that you think is important for people to know today?
Yeah, I mean, I just think that, appraisals are a concern sometimes with inventory levels as low as they are, because some people, or sometimes prices, you'll overbid on a home sometimes as a competitive nature to get the property, and then that appraisal may be overlist or slightly overpriced, or maybe an aggressively purchased home, and that appraiser may or may not come in at the value. So I would say just kind of be prepared to bridge the gap if you're in a competitive environment and you're paying a little bit more from a house than let's say the guy that you're in competition with. Because that appraiser might not have the comp that is in the market 6 months from now. Maybe it's a new construction or something. That comp will materialize, but it hasn't quite materialized, even though you're at a price point where you're going to pay a little bit more than what you normally would for the competitive nature of the environment that we're in.
Yeah, you're going to become the comp.
Well, you might make the comp, yeah, but at the same time, cash buyers as well are not really a comp for us, because every lender needs a lender to be the comp. It needs to be a financed home. Cash buyers are a good indicator of a comp, but doesn't necessarily mean we can hang too much weight on that comp because it's not a financed home, right? And, obviously lenders will do a little bit more due diligence sometimes than a cash buyer.
All right. Well, thank you so much for your time today. I appreciate it, and thanks for all the insight.
Of course, yeah, we're here. If anybody wants to just reach out, give us a call. You probably know who we are. Just let us know if you need any assistance at all. Thanks.
All right. Have a great day.
Okay, bye, Adam.
Thank you so much for listening. Please be sure to subscribe so that you don't miss any episodes. Be sure to check out the show's specific website and our general website, hartmanmedia.com, for appropriate disclaimers and terms of service. Remember that guest opinions are their own, and if you require specific legal or tax advice or advice in any other specialized area, please consult an appropriate professional. And we also very much appreciate you reviewing the show. Please go to iTunes or Stitcher Radio or whatever platform you're using and write a review for the show. We would very much appreciate that. And be sure to make it official and subscribe so you do not miss any episodes. We look forward to seeing you on the next episode.